Hello, everyone, and welcome. Welcome to our Tezos quarterly webinar. And today I'm pleased to be joined by Ben Elvidge, Head of Commercial Applications at Trilitech, Greg Feibus, Head of Sales and Partnership at Midas, and Nick Donovan, Chief Revenue Officer at Archax. So today we'll focus on the rapid rise of real-world asset. Everybody's been talking about real-world assets, especially in the institutional space. And we'll look at tokenization on Tezos and Etherlink. We'll look at regulated commodities such as uranium to actively managed certificates, which represent curated investment strategies. So wide range of possibilities there. We'll also look at the developer infrastructure that is behind that growth and powering all that ecosystem. But before we get started, just a quick reminder that the information contained in this webinar is only for informational purposes, and it is not intended as investment advice. So that being said, well, let's go right into it. So let's go with a quick round of intros. So we'll go through each of our panelists, and I'll let you guys introduce yourself, share a brief overview of the type of work you've been doing at your respective organizations and what you're focused on. Who wants to get started?
I guess I can get started, Sacha. Thank you. So Ben Elvidge, I'm Head of Commercial Applications at Trilitech, which has predominantly been about leading our RWA efforts, most kind of prominently leading the efforts around XU308 and uranium.io. So very much ingrained in bringing a product to market and trying to grow that product, and we're starting to get some traction, which is great.
Awesome. And then Nick?
Shall I go? Okay, fair enough. So hi, pleasure to be here. I'm Nick Donovan. I'm the Chief Revenue Officer at Archax. I've been here for about 2 years now. My background is 20 years of working in different banks, mostly in FX and rates. So Archax, we're a London-based business, been around for about 8 years, FCA regulated as an exchange, a broker and a custodian. We were also the first name on the crypto asset register in the UK back in 2020. We've got similar permissions across Europe as well. We recently acquired a Spanish MiFID broker-dealer and also a German ETP and asset management business. So that's kind of the regulatory footprint of what we do. With those permissions, we're a tokenizer, we're an exchange, we're a custodian of a wide range of financial assets, both crypto and digital, plus traditional instruments. Plus, we're a marketplace for tokenized real-world assets. Our vision, which now seems to be becoming more and more inevitable, is that all financial assets are going to move on chain over the next 5 to 10 years. And our focus within that is facilitating that transition through the creation and trading of both the assets and the market infrastructure that's required.
Great. And last but not least, Greg.
Thanks, Sacha. So Greg Feibus, based in New York, worked for Midas as leading sales and partnerships. We are a European-based asset tokenization protocol who is bringing various yield opportunities on-chain. I would say was at first exclusively what we consider RWA assets, but kind of transformed to best-in-class yield opportunities that didn't exist for the traditional investor that had on-chain proclivities, let's call it. So yeah, really interesting time that we find ourselves in. But I would say our most recent kind of activities have been around bringing really unique DeFi strategies from top tier asset managers on chain to the extent that your retail all the way through institutional investors can get access. So yeah, really excited to be here and chat kind of RWAs and Etherlink more specifically.
Awesome. So let's just dive into it. We'll start with what's the macro overview of the RWAs. And before we get too much into each use cases and advantages, let's try to zoom out a little bit. So where are we today in the broader adoption cycle for tokenized real-world assets? Are we still in the experimentation phase? Are we beginning to see early signs of product market fit? Are we still in the early innings? If so, what sectors, what asset classes? What do you guys think?
If I may, so I would say definitely exiting, in my view, the experimentation phase for certain asset classes. I would say, yield-bearing stables, right, have found product market fit. I think that's really palpable based on their growth and understandable, given how high opportunity cost of capital is off chain, and so that obviously pervades on chain and makes those assets usable and gives them utility. So I would say that is clear. I would say it feels like we're still in the experimentation phase outside of that. I think Ben's a perfect example of kind of opening up the utility of a brand new asset that has historically been closed off to traditional investors, making it much more accessible. So I think where we are in RWA is more, we're really focusing on access still. I think there are some efficiencies that have come to light from on-chain RWAs coming on board, but it still feels like we're in the experimentation phase outside of kind of this yield-bearing stablecoin space. But would let anyone else kind of weigh in here as well.
Yeah, maybe I can add to that from a sort of an institutional perspective. I mean, we've definitely seen a massive change in the last 12 months or so in terms of engagement. Maybe you could sort of mark the turning point as being a sort of a combination of, kind of the regulatory clarity in a number of jurisdictions, but not least the US, but also, BlackRock's BUIDL being launched, the ETFs more broadly across a bunch of different asset managers. But I think that kind of time frame onwards, early 2024 onwards, has definitely seen a huge change. And that change is kind of, we can joke about it being the shift between the different POCs. You might call the experimental stage the proof of concept stage, and then everyone was doing proof of concepts for the last few years, and now everything's production on chain, and that's a massive change in terms of what we see institutions doing with us and what they work on, and nearly all of them, nearly everybody we talk to has shifted from that mindset towards how do we do things in production, really on chain, and move towards scaling them. Yes, it's still very early product market fit, and yes, there is some element of experimentation still within that, but the mindset has gone from being tick box exercise around doing something in blockchain to being how do we actually do things here and make it scalable.
Yeah, you're not going to get much of a contrarian view from me to both of those points, Sacha. I think exactly right. Definitely, I'm not sure anyone could disagree that stable coins have probably found product market fit given their adoption and usage, and now traditionally conservative institutions, the JP Morgans, BlackRocks, Goldman Sachs, even sort of looking at this space in terms of whether that's stable coins, tokenized deposits, or short-term fixed income. That really is where we're very much in that scaling phase. As we look beyond that, as Greg was saying, I think I'm super excited, but also curious to see how the wider asset class adoption that is being brought on chain plays out. Obviously, I've got a vested interest in commodities, given what we've done with uranium. We think that works, and that's pretty much institutional grade. But even things like tokenized stocks, like how do you move from a underlying asset that is traded 5 days a week to something that's now available to be traded 24/7? I think what will really be the test over the next 12 to 24 months as to whether we're truly getting out of that experimentation phase is going to be breaking down that friction between the real world and the on-chain world when it comes to practical things like round-the-clock trading. When the underlying assets, and that's even true in the fixed income space, right? If you're looking to go beyond daily yield distributions in a fixed income product that's on-chain, how do you do that when the native asset underlying isn't issued in that sense? So I think that sell side issuance piece is going to be really interesting as we move forwards over the next 12 to 24 months, and whether, like the regulatory piece, like the institutional piece, things start to catch up. And then I think it's all, all gas, no brakes for bringing everything on chain at that point.
Yeah, I mean, also it's been really fascinating to watch how I feel like before this administration, innovation was more traditional Rails trying to mimic some of what crypto had done, and now it's kind of like but with inferior technology, and now it's finally like getting to fruition and getting there. So obviously, real world asset tokenization is one of the hottest topics in the blockchain world, and as you mentioned a lot on the institutional side. What can you share your thoughts of the kind of solutions that these offer in the short term and the long term, and divide those between institutional use cases and more retail use cases? So what are the types of solutions that are coming to light, and what are they for institutions? What are they for retail users?
Yeah, I guess I can start here. So I think, if I think about it from an institutional perspective, firstly, the big driver, as with most institutions, is around how do you increase operational efficiency, and obviously bringing things on chain absolutely does that. So removing some of the intermediary steps, even in the traditional asset management business, like transfer agency and the like, and automating a lot of that settlement, reconciliation, and reporting activities. So that should reduce time and cost. So that's a big win for institutions. But also, getting access to broader liquidity when you start to have deep on-chain markets that are trading 24/7 and across jurisdictions globally. I think one thing we don't often talk about for institutions is new distribution channels. We look at it from the retail angle a lot of the time, about retail investors accessing products that have been only accessible with tokenization and fractionalization to institutions, but also for institutions, the inverse is true, right? For institutions, you're gaining access to a pool of new investors that otherwise weren't serviceable because of the operational inefficiency of dealing with lots of individual investors. Tokenization and bringing that on chain does help with that. And then true for both institutions and retail is the wider composability, and it's certainly what we're looking at with uranium, right? So how do you transform interesting and helpful assets from an asset allocation perspective in the commodity space, like with uranium, and because it's on chain, leverage that composability with other protocols to increase the utility and benefit of holding that asset. So can you generate yield with that asset? Can you use that asset as collateral, et cetera, et cetera? And it's similar themes from my perspective, and I'd love to get Nick and Greg's thoughts as well. But from a retail perspective, the big one is obviously you lower those entry barriers into all different kinds of asset classes. And if I put my TradFi hat on and my CFA hat on, right, you want access to as many different products that can diversify your portfolio as possible. I actually think tokenization and RWAs really do give you that, and the breadth of assets that I hope we'll start to see on chain and make accessible to individual investors is gonna reap a lot of benefit for those investors and the market writ large.
Yeah.
Lower costs is the other big one that I've not touched on for retail investors, because obviously if you can strip out those administration costs, as we call them in the traditional asset management world, so transfer agent fees, other administrative fees, because it's all being managed in a programmable way with smart contracts, I think that also, we hope, should pass on lower cost to the end investor. And just, again, having tradable 24/7 access and an ability to access those assets and trade them 24/7 globally is also something that should be helpful.
Yeah, Ben covered most of it all in there. Go ahead, Greg.
Sorry.
Wait, nice job, Ben. Yeah, I would say what echoes with me, given the many of the users that we kind of interact with, which again range from retail all the way through institutional, with the skewness, I think, being more towards the kind of higher net worth retail side, I would say. is a bit more focused on access, right? So it's taking products that are either jurisdictionally or gated to certain users. So now that you see, for example, equities coming on chain, right? It's less about, oh, there's not enough efficiency in this market. We all know there to be, incredible efficiency in equities markets. It's perhaps one of the most efficient markets in the world. They've been electronified for a long time, and I think it's one of those things where they're super accessible to those in that specific jurisdiction, but it does kind of globalize equities markets where now investors who were once gated from getting access to, let's say, Sony or Mondelez stock and had the ability to do so through something like ADRs, right, don't have to kind of use that same process, and now they can just access it on chain. So it's more of an access point, I think, for the retail investors, and it obviously allows for them to get access to, in the case of Midas, fund generated strategies with no minimums, right? With no $500K $1 million ticket, and the ability to instantly or atomically swap into and out of these assets, such that they're not locked in like a 30, 45, 60-day kind of redemption period that's that a traditional fund requires. Right. And so then the second degree of that is the composability element, where you can pledge those assets as collateral, borrow against them, provided, a certain risk curator has underwritten the asset from both a volatility profile and an overall kind of market credit risk perspective. So it's taking it to a different level in that respect. I would say from the institutional side, I would agree with you, Ben, in that when institutions look at these types of assets, I think the first thing that comes to mind, which is why I think we've seen the emergence of a lot of DLTs in the banking sector, is they're looking at cost cutting, and they're looking at how do we remove certain costs, drive efficiencies. And if you look at like these private DLTs that are meant specifically for repos and things of that nature, I think that was the initial supposition around driving cost, driving efficiency. They're effectively like, I guess we romanticize them about them being blockchains, but they're really like private databases that allow for kind of intra-bank, client connectivity and things of that nature. So, I think again for retail, more about access; for institutional, at least at the beginning, more about cost cutting and bringing down costs for certain operations. But also, I agree in that it's also becoming the case where they're finding out it's also bringing new liquidity pools to them. So it's not creating liquidity within these assets, but it's opening them up to a new capital pools from investors that they otherwise wouldn't have faced in kind of traditional business. So.
Yeah, I agree with all of that. I mean, you really simplify it down. It's whether you're an issuer or a consumer, and the issuers, and we get asked this all the time. It's generally the first question from the institutions is, how is this going to be distributed? What am I opening myself up to here? Yeah, and both in a good way and a bad way. What unknown people am I opening myself up to, but what pools of capital am I opening myself up to? So it's both that new distribution channel, but it's also the utility, right? And the utility is starting to come. Collateral networks and the like. How do I use this asset? I mean, tokenization, remember, is the easy part. It's what you do with the token once it's created, especially if it's a security. How do I custody it? How do I get my clients to custody it? Who's going to market make this thing? How do I create secondary markets in it? But again, that thing's the institutional side. You're absolutely right. The cost efficiencies, post-trade, reconciliation pieces, all of that stuff, that gets realized at scale. And then the retail side is access and ways to consume 24/7, whatever it might be. But I'm sure we'll dig further into that in the next question area probably.
Yeah. So let's directly go into it. I think we've touched on some of the points here as well, but let's really focus on what real world problems that tokenization solves for institutions compared to legacy infrastructure, right? So what are there real operational or capital efficiency gains being realized right now? Is it going to be grow exponentially into the future? And are some of those gains being passed on to the retail investors yet?
I think that's kind of what I was alluding to at the end of the at the end of the last question. I think in the early stages, I think a lot of the tokenized real world asset benefits have accrued to the retail side, the consumer side, the access piece. I think that's where it's kind of accrued. The allure for the institutions, which is what Greg was referring to, the cost savings, I think they're achieved at scale. And when you're in the early stages of launching a product for the first time, the associated legal costs, structuring costs, all those kind of things, the launching costs, the amount of time and effort that's involved in working groups and committees and all those. You can't really say with a straight face that this is a cheaper way of doing this in the first instance. When you're doing your 20th, your 30th, then you start to get these things when you're really, really at scale. So I think at the moment, a lot of the benefits are accruing to the consumer side, not the issuer side. But ultimately, we know when we go from being, 25 billion to, 25 trillion, 250 trillion, as we keep going, right? That number that scales very, very quickly in terms of when you start to get the micro savings at huge volume.
I totally agree with what Nick's saying, and he touched on a really important point there in terms of this is, and it goes back to the very first question that you had, Sacha, around what phase of development are we in. I think, the cost savings, you need to have a long-term vision, seen what we've just done with uranium, right? I think there's probably no more cost saving in the time it took to set that product up and to implement that, working with Nick and the teams at Archax and other partners to get that right. But what we absolutely do see, and we're starting to see real interest now, is on that institutional side, people recognizing that it's not just the near, the price transparency and the other aspects that you get from being on chain that accrue benefits when you're trading this, but actually it's a much cheaper way than the paper-based processes and going to individual brokers and having that spread somewhat opaque. So that makes a big difference to kind of, I think, in the long term as you scale this. And I think we're certainly seeing from uranium and the conversations we're now having on other assets that blueprint can be reused, and that will be lower cost. And that's where I think we'll accrue some of that stuff. And then I think we covered a lot of it in the last sort of question that you asked. But in terms of other problems that it solves, it is that sort of, the only one we haven't probably really touched on is around transparency and trust and reduction of some of that counterparty risk when you're dealing with these assets, because it's all happening on chain and it's programmatic, rather than the sort of central clearinghouse model that exists in most asset classes now. But most of the other stuff, I think, is true to the benefits that we talked about in the last question. We just are yet to see all of those benefits accrue at scale, because the current TradFi capital markets model is geared towards making, clipping small amounts of fees, but at massive scale. And that's why the markets get dominated by the big institutions. And I think we have a bit more of a, by design, decentralized playing field in the sort of Web3 world right now. It'll be interesting to see how that plays out as RWAs scale.
Absolutely. The one thing I would add, you guys have covered the lion's share, but is definitely on the capital efficiency side. So again, when you make these assets composable, right, and they're integratable downstream within other DeFi applications, it definitely provides, provided it's again, these assets are curated, right, the risk is underwritten, and provided that's done appropriately, via different risk underwriting processes by the likes of a Gauntlet or a Stakehouse or RE7, some of these risk curators, MEV Capital, it unlocks capital efficiency, right? Because then you can kind of take that yield and lever it up to the extent where if you have the liquidity backstop to delever that position in an appropriate amount of time, as the market does perhaps gap down in certain circumstances. So you could do it in a way that you have, trust, confidence in. I think that unlocks capital efficiency. I mean, also when you look at in the simplest form, the likes of like a copper clear loop, right? Allowing for BlackRock's BUIDL token to be used as collateral on Deribit or something as kind of rudimentary as that. I mean, you're taking your collateral position and you're generating yield on it while you are trading. And so that, if you have a large notional position on for, I don't know, in commodities, right, it would be, you had a nat gas swap on for, 6-12 month tenors. That's a considerable amount of dollars that are enhancing the profitability of your position. Right. That could be easily the difference of being in the money or out, right? When you close that position out. So yeah, I think it's such a simple thing from that perspective, but it's increasing capital efficiency for sure.
Interesting. And so let's talk about size now. So there's efficiency and now size, TVL, volume growth, and maybe let's start with Ben. So we've seen a massive growth starting from May 2025 for Etherlink's TVL on the network. Can you share some details around that, around its tokenization behind that growth, and maybe explain a bit more the relation, what Etherlink is and the relationship between Trilitech and Etherlink?
Sure. I'll reverse the answer because it probably makes more sense to start with what Etherlink is, what Trilitech does in relation to Etherlink, and then talk about the sort of success. So Etherlink is the EVM compatible layer 2 or roll up on Tezos. So it's one of a number of roll ups that have been announced, and we started with the EVM one, the EVM compatible one, and it is all part of the same Tezos ecosystem, and so Tez is used as gas fees. And why that's really important is it enables us to give all the benefits of what you get from being in the Tezos ecosystem, but for those apps and those builders and those products that are sort of have started within the EVM or Ethereum ecosystem and realize those benefits on Tezos as well. And so that's Etherlink. Trilitech is the R&D or adoption hub for the Tezos ecosystem based in London. So we've got teams that are responsible for the development of the core infrastructure and the core products around the Tezos layer 1 and the various roll-ups that I've referred to. And additionally, we've got folks like myself that are responsible for driving forward new applications built on Tezos technology to really demonstrate the power. And of course, we've got our wonderful folks in the BD team, etc., that are working and finding those great projects to drive value, and great partners. So we've got 2 on this webinar that to sort of bring that wider utility to the Tezos ecosystem. And so all that being said, Trilitech, the wider sort of Tezos ecosystem have made a real push, as you rightly referenced, Sacha, sort of looking from March onwards this year around Etherlink. And so total TVL, is getting somewhere close to $50 million. And in terms of tokenization as a part of that, if you look at sort of aggregation websites like DeFi Llama, RWA projects on Etherlink are probably about $20 million. So they're a good proportion of that. And I think it played a crucial role in driving the TVL growth. And that's in part down to the products that we've launched. So, of course, doing really innovative things and opening up markets that have previously been inaccessible, like we've done with XU308 and uranium.io, but also bringing those high quality institutional grade products to Etherlink, like Midas, like Spyco, is all what creates that, ecosystem, to kind of overuse that word, that attracts users and then drives that ultimate growth. But I think in addition to the RWA projects that we've worked with and partnered with that have integrated Etherlink and that we've launched in the case of uranium, we've also spent a lot of time thinking about, well, how do we create that and deliver on that interoperability promise, right? So what are the other protocols and projects that we can bring to the Etherlink ecosystem, like Superlend, like Curve, that create and give opportunity for users and projects to benefit from that wider composability piece? And then we've wrapped around that, as many people will know that are listening to this webinar, it's been incredibly successful, the sort of Apple Farm incentives program. And that's enabled us to really tap into, incentivizing the behaviors of utilizing real world asset projects and tokens like MT-Bill and so on in other protocols that are available on Etherlink. And it's created this really nice virtuous circle of adoption. And we're really excited about where it's going to go, not just with Etherlink, but with also the other smart rollups that are coming out and will be released into production later in the year.
And so you mentioned Midas, so might ask Greg, what's been going on in terms of growth in protocol TVL, and what are the kind of products that are behind that growth?
Yeah, so on Etherlink specifically, I would say it's been quite a nice story with the advent of the Apple Farm campaign. Now, I guess approaching V2. Right, I think it's gotten the user base very excited to interact with our assets on Etherlink. We found some composability right within Superlend, which is I would say driving some of that adoption. And certainly I would say initially, right, it was more focused on kind of liquidity developing on Iguana and in other places. I mean, Midas is the primary issuer of these assets. And so we have been on Etherlink, I would say, for the last, feels like around 2 to 3 months, and have been just seeing enhanced distribution and growth there. Our focus is on bringing new assets that are, I would say, have different, risk profiles, different yield profiles. And so, we started out with T-bill and basis, and subsequently deployed MRE7 yield and MEV as well more recently. And so those assets are what we call actively managed certificates. They represent exposures from those funds respectively, so MEV Capital and RE7 Capital. So really prominent DeFi funds who are trading various liquid strategies, all I would say delta neutral strategies, so everything's fully hedged, but also they're LPing into different opportunities even outside of Etherlink, right? And so the benefit to Etherlink users is that the yield from those strategies accrue to token holders on Etherlink, even though the underlying strategy that collateralizes these tokens is multi-chain, right? And so it's it's a bit of extractive value for Etherlink users, right? Getting best-in-class DeFi yields, but also bringing them back to Etherlink token holders. And then, right, the second, the downstream impact is being able to use those tokens, pledge them as collateral, borrow more stables against them, and then either buy more of these AMCs or, right, go invest in MT-Bill or Spico tokens, right, and get another 4+% yield. And so, right, that's the benefit of having that optionality and allowing you to be nimble in terms of the way that you manage your positions, based on the fact that, right, you can exit these tokens same day versus waiting 30, 60, 90 days for, to get your capital back. So, very interesting growth story, and we look forward to deploying more assets on the network.
Yep. And Nick, what about Archax? Across your product offerings, what areas have seen the strongest client demand, and how do these products impact your primary and secondary markets?
Well, it's hard to say which particular product or area of what we do. I mean, but broadly speaking, a huge increase in demand for tokenization, and we're a full platform full service platform ecosystem, however you want to describe us, that ranges from, and we work with different projects in different ways, not all of these things, but it can range from being consulting or structuring. It can be the actual tokenization itself, distributing via primary or secondary markets, custody, whether it's a security or not a security, we cover all of that as well. So, so we see all the different aspects, but all of those areas, like the demand, the thirst, even for just knowing how to create and go to market with the token in a compliant manner, like just the number of sort of inbound queries around how to do that has just exponentially increased over the last 12 months or so. So that's been great to see. But the demand's mostly been for the liquid products, let's say, tokenized treasuries, tokenized gilts, tokenized money market funds, and the people demanding those things at the moment tend to be more your sort of crypto native platforms, or people acting in a corporate sense for like treasury management, or stablecoin issuers managing reserves in pools of capital that exist, looking for those products for their management. But now, I guess, as you starting to see interest rates come lower, there is definitely demand for higher yielding products, or as some people describe them, sort of money market fund adjacent products, which makes sense. And then, as we'll come on to it with U308, there's definitely a demand now for sort of tokenizing a broader range of assets, whether that is commodities, whether it's real estate, whether it's insurance, and frankly any kind of asset. We've seen there's a lot of conversations ongoing with people bringing really innovative and in some cases esoteric products to market. So, you mentioned about the primary and the secondary market. So all of this requires people to then list for firstly the initial distribution, and then trading of their tokens to allow their investors to be able to enter and exit in some sort of efficient manner. But there are challenges there. I mean, certainly from a from a primary perspective, when you're dealing with subscriptions and redemptions, again, Ben mentioned it in one of the earlier questions, there's this mismatch between the 24/7 expectations of and crypto experience that you generally get used to, and the kind of 9 to 5 work weekday operation of financial institutions in the traditional world. And we spend a lot of time sort of developing 24/7 solutions that bridge that gap. And then if you shift to the secondary market, a lot of these real world assets that are being tokenized are illiquid. And when they're illiquid, they don't lend themselves to a central limit order book, a CLOB environment with market makers and the like. And even if it did, then you've got the challenge of, do market makers want to do real world assets, whether they're a security or not? And if they are a security, can they do it in the first place? Mostly can't. But yeah, so I mean, most of that sort of secondary market then drives itself or lends itself a bit more towards kind of bulletin board type environments where we're matching interests from different buyers and sellers. But it's it's clunkier than what you might ultimately want to end up at.
Super interesting. And so, in terms of RWA specifically on Tezos, so Ben and Nick, let's talk a bit about uranium.io. So it's built with Archax support, deployed on Etherlink, and it's brought regulated physical uranium trading on chain, starting from last December. Nick, you've alluded to some of the complexities in getting some of those started. What type of hurdles did you have to overcome to be able to do that, to tokenize such a sensitive commodity? And why did you choose Tezos for the settlement layer?
Yeah, so in terms of hurdles, there was many. So I joined the project, just over a year ago, but a lot of thinking had gone into it way before that. And as you say, the asset itself, as we would all hope, is pretty highly regulated in terms of taking physical delivery. But it's important to note that the actual activity of trading, like most spot commodities, is not a regulated activity. And so a lot of time in terms of challenges was spent and continues to be spent educating people about the nature of the asset, the nature of how we, in partnership with Archax, we've managed the tokenization, and it's quite a unique structure. So there's no SPV in the middle for the tokenization. It's purely just the trustee, which is Archax, sits there. And if you hold XU308, you have beneficial ownership of the physical uranium that's in regulated and secure storage, as is required by law. So that kind of structures, there's not many people doing that, and or hasn't been. We expect that more people will start to do it, having seen the benefits of what we've been able to do. But in terms of tokenizing an asset like uranium, the market is primarily and pretty much only OTC right now. There's a futures market on CME, but it barely trades. And some of the big challenges are things that we spent a lot of time talking about, and Nick, I'm sure, is often sick of talking about it. But how do you manage things like token issuance when there is increased demand, when you've got a up to 14-day settlement cycle in the physical world, but you need to mint tokens immediately to get them out to meet that demand, right? And so, or near immediately. So how do you have the operational processes around that to manage that? How do you balance the desire for that crypto or Web3-like experience with the needs of sort of regulatory requirements around things like KYC and AML checks? That was a big challenge, and we made some big breakthroughs there. But in short, I would summarize, and Nick can add anything else that I've missed here from his perspective, but a lot of my time is spent on the sort of education side about what the asset is and isn't, and why this can happen. And when we talk about things like physical delivery in the uranium space, you still need to have a converter account. It's not like you can get delivery of uranium to your front door. So it's very sort of educational stuff.
Yeah, totally. I mean, I think a lot of that early stage was all around the legal and the operational structure, right? Trying to get that exactly right, given the nature of the underlying asset, and to Ben, as Ben's saying, right, that this token is just a record of your ownership of physical uranium, and physical uranium, the definition of that, as he alluded to, is the financial element of it, not the actual not the actual physical, if you know what I mean. But yeah, I mean, I touched before on like the market making side of things. Again, there's a lot of challenges in here in finding the right things to make the overall product from the very inception through to it being at scale and gone to market, to make all of that work all the way through. And for us, we're the custodian via the sort of the Canadian converter account. Getting that account even in the first place was challenging. There's a lot of effort goes into that. I mean, it's only because we're highly regulated that we're able to do that, given how regulated the underlying asset is. So yeah, echo all of that.
And so hopefully, finally, doing the hard work, the regulatory hard work is going to bear fruits and provide real value to consumers. So, Greg, over to you. Talking more specifically about the Etherlink stack, what makes it an appealing network to? You alluded launching a yield product and at Midas and giving world-class yield from other chains and the composability. Are there also other product designs that you can deliver on Etherlink that would be impractical on other chains? What is your approach there at Midas?
Yeah, that's a good question. I would say, I would definitely mention the low latency plus, the fast finality for better UX. That's certainly one thing, as well as like the modular compliance tooling. If we were to ever bring kind of, a more call it permissioned product to Etherlink. Right now, the products that Midas has deployed on Etherlink are all permissionless after primary mint. And so the assets are permissionlessly transferable. This is all under the guise of our accepted base prospectus in Europe from the Liechtenstein FMA, which passports across the EEA and into the rest of the world. So for us, we've kind of stayed in this permissionless type space for a while. We have recently released an asset tokenized the Fast and Arrow private credit fund, which we brought on chain as an asset called MF1, which is really a collection of various different portfolio underlyings. But I would say it's mostly comprised of like SMB, short to midterm duration loans. And then there's also a digital assets kind of market neutral strategy that is, makes up some portion, I would say 20 to 30% of the exposure within the overall fund. We're exploring, bringing assets like that on chain to Etherlink as well, to kind of diversify the offering there for the users, and to provide some additional avenues for allocations from for any user on the chain. But yeah, I would say just as much as it's about like the technical implications and what the chain brings in that respect, it's also about like what's the ethos of the broader group of participants on chain, like the set of apps there, and also like the foundation who is helping to shape the narrative. So I think part of it is around Tezos being really forward about their and kind of pushing this ambition of RWA adoption within Etherlink, and we found that very attractive, especially as an early stage protocol. We launched last year, and so we're now we just surpassed, I think yesterday, $600 million of TVL, not specifically on Etherlink, but in totality. So I think for us, it's taking shape purely organic inflows, right? We have no governance token that we're kind of using to incentivize deposits, which is amazing to us because it shows that there is product market fit and people are looking for risk adjusted yields. So yeah, I would say not to be too verbose here, but I think it's as much about the actual technical aspect as it is the ethos of the overall ecosystem and the foundation that's backing it.
Yeah, I mean, and that's unlocking new speeds of growth. And as you mentioned, behind this, there is a foundation. There's Trilitech that's developing a lot of those systems to enable faster growth. And recently in March, there was the Calypso upgrade. There was also the Dionysus upgrade. Ben, can you tell us a bit more about those upgrades, their purpose, and what they've achieved for the network?
Yeah, I'm conscious of time, I'm a product guy, not necessarily an engineer, but in short, it's a lot of what Greg was alluding to there, which is great to hear from a partner within the ecosystem, right? Which is the upgrades that have been made are very much about making Etherlink and continuing to iterate and improve on making Etherlink a better blockchain, right? So more resilient, more performant, and particularly the focus, given the ecosystem growth around Etherlink, is what are the things that are important, to drive these DeFi and RWA applications forward. So, in Calypso, it was very much about increasing sort of storage and speeding up storage access. So that was part of the Calypso upgrade. We did so that improved finality, as Greg mentioned. Smart contract speed boost was important as well as sort of lowering some of those node requirements. And what's really important for us is that sort of getting as close to a seamless experience from the layer one to the various rollups. So Calypso brought in the foundation for fast withdrawals from Etherlink to Tezos layer one. And then that was improved upon further for kind of all FA compatible tokens in the Dionysus upgrade. And then Dionysus was very much building on those benefits from Calypso, right? So how do we give more predictable and user-friendly gas fees? So stopping some of the spikes that we saw earlier on within Etherlink. How do we ensure that it integrates with the wider Tezos X roadmap even more in terms of the data availability layer integration? So that increases block capacity and enables, and also a big part of the Dionysus upgrade was about enabling more support for large and complex transactions. So within sort of keeping gas fees controlled, also enabling those support for the types of high frequency calls and complex calls the DeFi apps typically and DEXs are typically making, right? So we can support all of that and remain in sort of the mission statement of that, fast, fair, and nearly free ethos that we've got for Etherlink, which I think summarizes what most of us, sort of from a TradFi background for our sins that are now operating in the ecosystem, really care about and have always cared about when we look at any sort of core infrastructure stack as we want to build new applications. And it continues to be, the beauty of being within the Tezos ecosystem is sort of the enshrined governance and evolution that has always been a part of the Tezos ecosystem, and that's very much a part of what we'll continue to do on Etherlink as well.
And on the builder side, Greg, how have you felt those reductions in gas fees or in infrastructure?
Yeah, I mean, it just ends up manifesting as a higher net yield for the token holder, right? And so, everything that we pass on in terms of yield is a net yield, and so, right, any reduced gas fees just allows for, greater net yield for the end token holder. I would say that's a must, right? When you look at, when I look at our deposits on Ethereum network, for example, you'll see, large deposits, less kind of in and out activity, more so like buy and hold type of activity. But I would say, on Etherlink, we see much more velocity of capital. We see more users interacting in not just small deposits. I mean, it's a variety of small, medium, large deposits. So I would say there's more. There's a variety. There's a larger range of deposits and redemption cycles. And so I think the fees naturally allow for that, right? Reduced fees allow for that type of activity. It allows users to be more nimble in terms of their looping on these assets within the likes of Superlend and other, future lending protocols. So yeah, it's definitely like a differentiator in terms of how users are able to interact with our tokens because of that.
Yep. Perfect. And so, being conscious of time, unless Nick wants to add something on this, but let's look ahead and see. Okay, so we've have all those building blocks. They're shaping up. Growth and TVL has been tremendous. Upgrades are coming up to have even better tools to build there. What features of the Tezos and Etherlink stacks do you expect to change the most in the next year? And obviously, what impact do you expect that to have on for RWAs on the network?
I don't know if it's change as much as evolution, right? And I think what I expect and what we're starting to see is, even more larger, well-established protocols take curve, for example, recognizing the benefits of what we've built and got on with the Etherlink capabilities and sort of integrating Etherlink as well. And so, what I think we'll see more of and what I hope to see more of is, as we continue to evolve both Etherlink and also the layer one and the kind of interoperability between the two, that we see more and more utility and applications and protocols and more projects becoming part of the ecosystem and seeing the benefits they can have by integrating Etherlink and or the layer one and being part of the wider Tezos ecosystem. And I think what's really exciting is some of the stuff we're doing on the wider Tezos X roadmap, right, around the Justice rollup, which is the JavaScript rollup, which I think makes things really interesting, where you're tapping into a pool of such a huge pool of builders that are familiar with JavaScript, being able to then enter the Tezos ecosystem and gain all these other benefits that we've been talking about on the rest of this webinar. So I don't envisage fundamental changes per se, because we've got a clear vision with the roadmap, but I do envisage continued evolution and responsiveness to the growing ecosystem and the needs of that ecosystem, right? The kind of gas control in the Dionysus upgrade is a perfect example of that, where we were very quickly able to respond to, project feedback and implement that in the next proposal and get that approved and implemented. And that makes a big difference, as Greg alluded to. So very much the same story has always been the case around the Tezos ecosystem, right? One of evolution rather than big bang change. But I'm excited about the wider remit of the projects and protocols that are coming into the Tezos ecosystem, because they're realizing the benefits that can bring them.
Yep. And Greg and Nick, anything to add, or what type of RWA product developments are you most excited about for the coming year?
Yeah, I think just to build on what Ben was saying, right? The success begets more success in these things. So as things like uranium or other products, other projects that are on Etherlink, as they grow, they'll attract, that success will attract more products, right? And where I personally get excited is when you start to think then about what the second order products become, things like RWAs that then start to have on-chain futures markets around them, or you get multiple commodities and you start to think about commodities indices and things like that. So it's kind of that success, really watching how that trajectory evolves. I think that's really exciting about how this space will develop from a broader Archax perspective, and again, not specific to Tezos, but more broadly. The next year for us, we're excited about, and I've alluded to it a few times. Our Spanish entity comes with market making, or called trading on own account permissions. So it's a MiFID. It's an entity that has the permissions on both sides of the equation that would allow it to be an RWA market maker. So we're really interested and excited to see how we can develop that side of the business over the coming year. And then also we're very close to getting permissions in Luxembourg for our on-chain CSD, so a central securities depository. And that for us is another unlock in the secondary trading through our MTF for tokenized securities, which will really allow us to issue a lot more instruments where that CSD in Luxembourg could be used for the on-chain books and records, the legal title transfer, and so on. So those two things for us, I think, are really big unlocks.
And what about you, Greg, at Midas?
Yeah, so as far as Etherlink goes, we're excited to keep, I would say, deploying new and innovative products there. One of the benefits of Etherlink is that, I would say this is more anecdotal than anything, but it feels like it never suffered the cold start problem from launch. And so, right, you have this kind of continuous development of, and new products, integration of those products into the ecosystem, and subsequent deployment of new products, and is the way that it feels. And I know Lombard is coming to Etherlink, and there's some other projects that are including other RWA projects. So it feels like the ecosystem continues to develop day over day, because it never suffered the cold start problem. And these products are coming in, new users are coming in. There's an incentive, the Apple Farm program kind of overlaying all of this. It just feels like it's a continued building of both TVL and new users. So it's definitely accretive in that sense. For Midas overall, I think, new products that are differentiated from the existing ones. We're bringing new asset managers on that had differentiated strategies. So I think we're evolving into what feels like a bit of a marketplace, but not exactly. And really just giving asset managers and different assets or asset issuers the ability to come on chain and to reach new users. So for us, it's an ecosystem that we're happy to be involved with, and we think offers a ton of growth heading into the remainder of 2025 and into 26.
Perfect. And lots of things to look forward to. So I think we'll leave it there and start wrapping up. So to wrap up, please tell us, we'll do a quick round of any final thoughts, and then where can we find you on social media?
Yeah, just a few final thoughts from me. Thank you, Sacha and Natai, for hosting the webinar. It's been a great conversation, as evidenced by bumping up against the time. I think you can find me on social media the same as my name is spelt. That's just my handle on X. But more interesting information, I would argue, you probably find by following uranium_IO, which is everything to do with the uranium.io project, and keep an eye out for additional composability for XU308, as well as new commodities using that same blueprint. So exciting times ahead. Thank you again.
Yeah, and for Midas, it's at Midas RWA on Twitter. at Greg Feibus, no dash, no space. But yeah, please follow us there. Excited to keep building with everyone here, and looking forward to the remainder of 25.
And from my side, final thoughts. Obviously, we're early, but the stars are aligning, so it's all very exciting. You can find Archax at archax.com, and myself, my Telegram handle at Nick Donovan.
Awesome. Well, that's it for our quarterly webinar on how RWAs are reshaping investments on Tezos. Thank you so much to all of you for joining us. For those who are listening, thank you so much for our amazing panel today, for providing your insights, and very exciting very excited for the year ahead. Thanks everyone, and see you next time.
Thanks very much.
Thank you.